conducted by scientists who come from all over the world to work there. It's also believed to hold significant oil and gas reserves, and presidents over the course of the last 70 years have consistently denied oil and gas companies looking to drill there until the prior administration, which issued, my understanding is, 9 oil and gas leases. Those were stopped through executive order in January 21, shortly after President Biden was elected. And I thought it was worthwhile to spend a moment to talk about that. What Biden is doing is he's trying to weigh the needs of the country as opposed to the needs of business. And the needs of the country are very closely aligned with protecting what is clearly a part of Earth's natural heritage. So we take a look at data that came in at the end of last week. We see that we had some very important data that came in on Thursday, Friday, and this morning, which confirm what we already know, that the combination of strong profits, record fiscal and monetary support is going to supercharge the economy. And we're starting to see jobless claims come down and the rest of the economy begin to grow at an accelerated pace. And so we had jobless claims that came in at 553,000 for the prior week. The headline was jobless claims hit a new pandemic low for the third week as labor markets pick up. GDP came in, I'm sure many of you know by now, at 6.4%, which was a gangbusters number. And the headline was resurgent U.S. economy grew 6.4% Q1 with faster growth ahead. So two very positive data points that came in on Thursday. On Friday, we got personal income, which jumped over 21%, which was due largely to the stimulus. But again, a huge jump in personal income and also a jump in consumer spending, which soared after Americans got those stimulus checks. So again, two very positive data points came in on Friday. And today we got manufacturing numbers. And the headline is that the index fell from a 38-year high with shortages seen in parts, material, and labor, adding risk to a fast-growing manufacturing sector. We talked about some of those bottlenecks in the supply chain that are a source of concern. When you have bottlenecks in the supply chain, what's that likely to do to prices?
Excuse me, what was the question?
If there are bottlenecks in the supply chain, what's that likely to do to prices? It's going to raise prices. That's exactly right. So there's some downward pressure coming from the supply chain bottlenecks and some rising price pressure within the manufacturing sector. However, if we look at the graphs, we see on the left manufacturing numbers have since the collapse of manufacturing in the beginning of last year have really recovered and continue to match our expectations, which is as the economy expands, manufacturers, producers are seeing end demand increase, and they're increasing their orders for precursor inputs, which are those raw materials we talked about. If we look on the right here, we see motor vehicle sales, which is another barometer for the health of the economy. The fewer vehicle sales there are, the less healthy the economy is, because that means fewer consumers are buying cars, and cars are a very popular purchase here in the United States. And so what we see both in manufacturing and car sales tracks exactly what we've been talking about for the last couple of months, and confirms what we expect to see, which is increasing motor vehicle sales and increasing manufacturing. As it turns out, at the end of last week, the Baltic Dry Index reached an 11-year high on Friday, extending its increase to 13 sessions, as supported mainly by rising iron ore demand from China. So we're seeing manufacturing numbers go up, and that's being carried through to the Baltic Dry Index, which tracks shipping rates around the world. And the headline was, shipping index is signaling global expansion amid surging demand. And the WTO today released a report that said trade recovery is faster than expected, but regional disparities persist. What are those regional disparities about right now, you think? What's getting in
Well,
the
I
way
think
of
we can.
countries resuming? What's getting in the way of countries resuming their normal trade activity aside from bottlenecks to supply chain?
I
COVID?
think we still have India, who's a very big exporter, who's having a big problem, recovering from COVID.
That's exactly right. That's exactly right, James. He hit the nail right in the head, folks. Everyone here, James. The drag is varying degrees of success with the vaccination program and the emergence of new variants that could very well challenge existing immunization protocols. That is to say, whether or not the existing Pfizer vaccine and Moderna vaccine would be resistant to strains that are being discovered in India, which is facing, we know now, catastrophic numbers and a catastrophic loss of life. And so therefore, that's going to have to be, we would expect, to drag on the global recovery. The hope is, though, is that nations are going to rally and provide the support and vaccines and direction that other nations around the world, like India, as James pointed out, so desperately need. The point is here, I wanted you to see that the Baltic Dry Index surged again at the end of the week, reaching 11-year high, and that there is a direct correlation between what it's doing and what manufacturers are doing and what trade volume, merchandise trade around the world looks like, which is why it's one of the key measures that we as global managers rely upon to get a sense of what the economy should look like over the near term. So in terms of a review, I wanted to just take a quick review of what we looked at on at the end of last week on Wednesday. If there are any questions as we go through this, let me know. I did post answers to Chapter 9 on Blackboard this afternoon, so that's up there for people to look at. We talked about business pathways, starting with the pathway that gives producers the least bit of control but gets them access to foreign markets without a major investment, with fees being paid to the company in exchange for technology or trademarks or patents that the company has. So the company gets a fee, and another company, the licensor, is going to produce and then sell those goods. The problem, we said, is difficult to ensure quality control. Next, we talked about franchising, again, giving companies access to foreign markets, followed by periodic fees. Another vehicle that doesn't require a major investment. Joint ventures, we said, again, access to foreign markets, access to specialized skills with your partner. The real challenge here is ensuring quality control. It's very hard to find a good JV partner that is going to be there with you through expansions and through contractions as well as expansions. And so we said that was one of the drawbacks of a joint venture, is finding the right venture partner. We said next up on business pathways, we talked about the acquisitions of existing operations, which can be positive because it allows a company to develop market share quickly. But of course, you have potentially high entry costs if you acquire the manufacturing capacity of another company. And while you acquire the manufacturing of another company, you may indeed be acquiring some of the flaws in the system. So if you acquire a factory from Ford that produced one type of car and you're looking to adapt it to your production, there may be issues relative to that. And of course, that's going to be less compelling an option than perhaps establishing a new foreign subsidiary from the ground up, which is a greenfield investment, as opposed to buying an existing operation. This is one way to neutralize the risk This is one way to neutralize the risk associated with buying an existing operation that MNEs need to weigh when they do their analysis, whether or not it's worth the additional cost to pursue a greenfield investment, which can be potentially more expensive, but also in the long run more cost effective. Why? Because you're able to tailor the subsidiary to exactly your specifications. It's bespoke. It's custom made. Okay. We point out here, of course, that the largest portion of direct foreign investment are foreign acquisitions and new foreign subsidiaries or greenfield investments. We talked about reducing risk after direct foreign investment, and barriers to direct foreign investment. We said that, excuse me, it's a bit warm where I am. We talked about the importance of facility location, controlling transportation, technology, markets, and the brand name, maintaining a thin equity-based borrowing from multiple sources so as to develop goodwill to create stakeholders in your company's success, using local labor to, again, reinforce that goodwill with the local community, but also to exploit the skill sets that you'd be finding within the local labor force, to use a short-term time horizon on your cash flow recapture. That requires that everybody achieve certain targets within a shorter period of time, for example, 3 years as opposed to 5 years. And then finally, we talked about project finance, which was non-recourse funding. So in other words, a company is able to secure funding and it will be paid back out of future cash flows. Finally, we talked about taking insurance from the Overseas Private Investment Corp here in the United States, or through the World Bank's Multinational Investment Guarantee Agency. We identified just 4 types of insurance products. There are many others, but these that address the challenges that multinationals face when there are currency controls in place and they can't convert the local currency. There's no deliverable forward market. And of course, when the case arises that there's some type of civil strife that results in financial or physical damage to the multinational, its subsidiary, or to its employees. And of course, finally, insurance that provides against the loss of income due to political violence. Then again, we followed on with barriers to direct foreign investment. And there you have, from protective tape onto political instability, what we pointed out last week. From here, we talked about country risk and the different methodologies of pursuing country risk, from the checklist approach, the Delphi technique, quantitative analysis, and inspection business. And what did we say that most companies do? They do a combination of all these things. The one that gets the most attention, though, is the checklist approach, because there is a company up here in Westchester that publishes a monthly guide on over 100 nations, covering many political and financial risk factors. And so the typical M&E is going to use a combination of all these techniques, but we'll focus on the checklist approach, which does what? It helps companies to derive a measure for risk on a very simple scale of 1 to 5, 1 being the highest risk and the lowest value, and 5 being the highest value and the lowest risk. We talked about macro and micro assessments as well. We went through the methodology for the checklist approach, which is you're taking the political and financial risk factors that are found in the guide from the ICRG guide. They're given factor weights. Then those factor weights are valued at a percentage, and we're able to derive overall country risk from there. Are there any questions before we move on? It's just a quick review. I just wanted to put that up there on the screen in the event that it shot out to anybody or stuck out to anybody, something that they missed in the last class. Okay. Then let's move on to new material. We talked about all different types of techniques we've talked about several techniques that companies can use to manage risk in the global marketplace. And so let's take a quick review. We talked about companies' tools for managing accounts payable risk, to hedge the risk that the payables are going to increase because one currency may strengthen as opposed to another currency that weakens. We said that one thing the company can do is it can buy call options. Pardon me there. So the company can buy call options, it can buy futures, forwards, or now we're going to talk about how companies can enter into a swap to hedge their accounts payable. We said to hedge accounts receivable, companies can use a money market hedge just like we use with hedging accounts payable. You can invest against your payables or borrow against your receivables in the money markets, short-term cash markets. You can buy put options. so that the money you can come in, you can agree to sell your proceeds, sell your foreign exchange proceeds at an agreed upon strike price at some point in the future. That's your forwards. You can sell forward, you can sell futures, and of course you can enter into a swap. Are there any questions on this summary page here? Okay. So a swap is a pretty simple concept, just an agreement between two counterparties to exchange cash flows on specified dates in the future, calculated against some notional principal amount. You can think about it as a strip of forward contracts with different dates. So equivalent to a strip of forward contracts with different maturity dates, but the same price. Now, typically, there's no exchange of principal except with a currency swap. Now, we're going to talk about 5 different swap structures in this class over the next 5 classes, including tonight. Tonight, I'd like to talk about interest rate and commodity swaps. We're also going to cover currency, equity, and credit swaps. Interest rate swaps is merely an exchange of fixed and floating rates. Currency swaps allow companies to convert assets and liabilities from one currency to another, take advantage of different changes in foreign exchange. Commodity swaps, we see a spot price exchange for a fixed price. So an oil producer is concerned about what? Lower prices. An oil user is concerned about what? Higher prices. And so we can set up a commodity swap that meets the risk parameters of both the oil producer and the oil user. We're going to take a look at that a little bit later. Then we're going to talk about equity swaps, I think on Wednesday, which is merely an exchange of future cash flows based on an index like the Dow. I'll pay you a return on the Dow or on some stock in exchange for LIBOR on some notional principal amount. And we'll talk about some of the strategies that multinationals use in order to benefit from equity swaps. And then credit default swaps, where a buyer is compensated in the event of a loan or a credit event. If you remember from the 2008 Great Recession, credit default swaps were considered a significant flaw. Not so much a flaw as a financial product that was exploited by market participants. And we're going to talk about how that happened when we get into credit default swaps, I think on Wednesday or next Monday. Okay, so if there are any questions, let's move forward then. Let's talk about swap pricing. With swap pricing, there's a floating rate and a fixed rate. So you have a LIBOR buyer and you have a LIBOR seller. Now, the LIBOR buyer is going to pay what we call the ask swap spread. The LIBOR seller is going to receive the bid swap spread. The difference between what the LIBOR buyer pays and the LIBOR buyer receives is what the dealer gets. So let's take a look at that. So the LIBOR buyer is buying a floating rate. So he's a fixed payer. He's paying a fixed interest rate in exchange for a floating rate. So the nomenclature, the way that what we say is the LIBOR buyer is the fixed payer and the floating receiver, and as opposed to the LIBOR seller, which is the floating rate payer and the fixed rate receiver. Pardon me. So the LIBOR buyer, the floating rate buyer, is entering into what we call a pay fixed, receive floating interest rate swap. The LIBOR seller is entering into a pay floating, receive fixed interest rate swap. So we see our counterparties. In between them is the swap dealer. You have your LIBOR buyer and fixed payer on the left, and your fixed rate, your floating rate seller, your LIBOR seller, and your fixed receiver on the right, designated as counterparty B. So counterparty A is paying a fixed rate through the swap dealer to counterparty B, which is sending a floating rate over to counterparty A. All of this based on a notional principal amount. I'm pausing for a second in case there are any questions before we move forward.
Professor,
Yeah.
can counterparty B also initiate the transaction?
Pardon me?
Looking for, can counterparty B also initiate the transaction looking for fixed rate, pays the floating and receives the fixed?
Well, yes,
Or
of
is
course.
it
In
only?
other words, you're saying, that you're
Yeah.
saying that somebody is I'm earning, let's say I'm earning floating and I want to pay floating. Is that what you're saying?
No, let's say you're hedging against the volatility of LIBOR, and then you want a fixed rate. So
Right, so you think interest rates are going to increase, so
okay,
you want a
you
fixed
can
rate.
still do that, right? You
Of
can
course
also
you
do
can.
the reverse.
Absolutely.
Okay,
Absolutely.
got it.
You think interest rates are going to rise, and right now you're paying a floating rate on your debt, and you want to pay a fixed rate. You want to swap out of floating rate debt and make it fixed rate debt. That's exactly what swaps are for. So,
Got it. Thank you.
very good question. So let's talk about how we quote interest rate swaps. Interest rate swaps are quoted right off of the treasury curve, the treasury yield curve. So if we are quoting, if the 5-year treasury was trading at 270, and the 5-year swap dealer quote is a 20 bid, 24 ask, then the pay fixed party, the LIBOR buyer, will pay 294, 2.94% and receive LIBOR, and the floating payer, the floating rate payer, who is the LIBOR seller, will pay LIBOR and receive 290 fixed. The difference between the two, the 0.04% on a notional principal is what the dealer gets, which is 4 basis points on the notional principal. So if it was, right. So on a $10 million swap, it's a $4,000 price, okay, at 4 basis points. So if we're quoting 10-year interest rate swaps and the 10-year treasury was trading at 1.72, this is what the swap chart is going to will look like, a sample swap chart with the bid ask, with each of the 10 years indicated 1, 2, and 5 and 10 years. Now at 10 years, the bid is 205 and the ask is 220. So we can say 205 less the 172 means that the bid was 33 and the ask is 220 less the 172 is a 48 ask. So the swap dealer quote had to be 33 bid, 48 ask. So if the bid price is 205, if you look here on the right, you see how that was calculated. We said 172 plus 33 gives us the 2.05. Now we said the 220 ask, we just said the 172, which is the 10-year treasury, plus the 48 basis points, which is the spread we identified, gave us the 220. So we backed into what the dealer quote is based upon the swap rates that were quoted here and the 10-year treasury here. And of course, the spread between the 205 and the 220, the 15 basis points, is the fee to the dealer. Okay. Pardon me.
So will we do an example of this? Like if we have a LIBOR buyer or a LIBOR seller?
Yes, we will.
Thank
We're
you.
getting to that. We're getting to that.
Okay.
Were you reading my mind? But we're getting to that. I just want to lay out some of the mechanisms and how we do things, how we price. We've gone through the different types. Now we're talking about interest rate swaps and the pricing of interest rate swaps. And
Professor, I have a question. Can you please go back to the previous slide?
okay.
Is that how you get the 2.94 and the 2.90?
Right, because I said 270 plus 24 is 294. So I'm paying 294 to get LIBOR, and the LIBOR payer is going to receive the 270 plus the 20, which is 290. He's going to receive 290 fixed.
Okay, perfect.
Okay, and the spread between the two, the 4 basis points, that is the dealer price. And in this case, what we saw, I'm just going through the slides rapidly, we saw that the spread between the 220 and the 205 gave us a 15 basis point fee on whatever the notional principal was. Okay, so let's summarize this. Well, actually, before we do, let's talk about consolidated bilateral netting, which is a way that companies are able, multinationals are able to eliminate the risk of counterparty default. Okay, so that we take swap agreements between the two counterparties are put together in one master agreement with one net payment made to the dealer. Okay, what does this do? It's used to neutralize counterparty risk and add security in the event of counterparty default. So a bankrupt party can't say that it can't make its payment but wants to collect on an in-the-money swap. Okay, so it's another level of protection for counterparties that are entering into a swap. That's called bilateral netting, so that there's just one payment instead of each counterparty making payments. So let's take a look at an example. So here we have a firm that's earning 7% fixed, that's paying LIBOR plus 370 basis points. So at this point, LIBOR was 133. Excuse me, that number's wrong. Right. So that should say LIBOR plus 325 basis points. We're going to correct that before that goes up tonight. But it's the company is earning fixed and paying LIBOR. So it's earning fixed here and paying a floating rate here. So what does that mean? Its cash flows are disconnected. So it wants to either earn fixed and pay fixed or earn floating and pay floating. Okay, so here the firm can lock in a positive spread with interest rate swaps. So they're going to enter into a pay fixed because they're earning fixed and receive a floating interest rate. So that way they'll be earning floating and paying floating. So the firm is going to pay a fixed rate and receive a floating rate on its notional principal, and then it can use that floating rate to pay its floating debt. Okay, so what you're doing is you're offloading risk by recreating your cash flows using swaps. By far, interest rates are the most commonly used swaps of any of the swap structures that we will look at and that exist within the swap universe, because there are many other swaps in the fiber so that we're going to look at. But I wanted to focus on the most regularly used ones, and by far the most used are interest rate swaps. So let's take a look at a company that had in place a floating for fixed 4-year interest rate swap with payments that were due every 3 months. So they're paying a floating rate and they're getting a fixed return. So they're paying 3-month LIBOR and they're receiving 6% annual percentage rate based on a notional principal of $30 million. Again, the company is going to pay 3-month LIBOR and receive 6% on 30 million. So that means wherever LIBOR goes, they've got a 6% return of 30 million. Think about that, right? So if 1-year LIBOR goes to 570 at the end of the first 3-month period, the question is, what are the net cash flows to the company? So let's look. The company is going to pay 570. Why times 90 over 360? Can anyone tell us?
Because it's 3 months.
Because it's 3 months. Thank you. That's 427,500. They're going to receive 6%, 450. So that means that the net cash flow to the company is $22,500. Okay? So now let's take a look at another floating for fixed interest rate swap. Here, the company has $5 million floating rate asset and fixed rate debt. They want to hedge expected LIBOR changes, so they want to earn fixed and they want to pay fixed. So they have to swap out of their floating rate asset. So they want to get into they're earning floating so they can pay floating. They want to enter into a pay floating, receive fixed interest rate swap priced at 6-month LIBOR. So this part's March 1st, a contract for a 3-year floating for fixed interest rate swap was written for $5 million, just about 4+ weeks ago. Company A is paying every 6 months based on 6-month LIBOR, and company B is going to make a payment every 6 months based on a 5.5% annual percentage rate. So that no matter where LIBOR goes, again, company A is going to get 550 on 5 million every 6 months for 3 years. They've locked that in. So here we say the company pays 1-year LIBOR on 5 million. Company B pays 550 on 5 million. So if at the end of the first 6-month period, 1-year LIBOR is 410, what are the expected cash flows? Well, next September, if 1-year LIBOR is at 410, the expected cash flows will look like this. Company A is going to pay LIBOR 410. It's going to pay half of that because it's semi-annual. Gets them 102,500. So it's the 1/2 of the 410 multiplied by your notional amount of 5 million. Calculated through gets you the 102,500. The fixed payment, which is locked in an exception, which gets the company 550 every 6 months for the next 3 years, is going to be the same every period. It's 137,500. So the net cash flow to the company in this first period was $35,000, or will be $35,000 if that's LIBOR come September. So let's extrapolate that and look at what could be a variety of outcomes based upon estimates of what LIBOR might be over the course of the next couple of years. So we look at the periods from the first 6 months through the 3rd year. Here are potential 1-year LIBOR rates over the course of the next 3 years. We can calculate through the cash flow to each company and the net cash flow to company A for each interval. So here we see at 1 year, if 1-year rate is 460, we take half of that and we get times 5 million, gets us 115 payment, 115 going to company B and 137,500 going to company A. Again, we see the flow to company A is 22,500. And now I calculated through for each time frame. What you see is that the cash flow to company A remains the same. It's the cash flow to company B that's based upon LIBOR that changes. So as you can see, the various cash flows, we can add up the net cash flow to company A was 85,000. We can add up the net cash flow then to company A is 85,000. Are there any questions here?
So, Professor, if company A is positive in cash flow, it means that company B is paying that amount, right?
It means company B is paying that amount.
Okay, so it's a zero-sum game, right?
In a swap, every period, someone earns, someone loses. But in each case, both companies were able to hedge their risk using a swap. So let's take a look at another example where we're changing from a floating to a fixed rate asset. So here, the firm wanted to earn fixed on a $58 million asset, and it wants to pay LIBOR. They entered into a 5-year pay floating, receive fixed interest rate swap priced at 1-year LIBOR. That way they're going to earn fixed and they will pay floating. So the term was 5 years. The principal, the notional was 58 million. The payment schedule was every 3 months. So every quarter. So party A is going to pay 1-year LIBOR on 58 million. Party B pays 6% on 58 million. If 1-year rates fell to 510, what then is going to be the net cash flow to company A? Well, here we go. Company A is going to pay 1/4 of that 5.1%, or times the notional of 58 million, or 739,500. Company B is going to pay that guaranteed 6%, 1/4 of it, the quarterly version of it, based times the notional, which is 870, meaning that the net cash flow to company A here is 130,500. So let's summarize interest rate swap strategies. If a company has fixed rate debt and interest rates go up, you don't want to do anything because you don't want to pay more. If interest rates are going to go down, you want to swap out You want to swap out of your fixed rate debt. You want to pay floating and receive fixed.
Professor,
Yeah.
why would somebody sell to you a floating if the
If
fixed
interest
rate?
rates are going down, why would somebody do that? You're saying?
Yeah,
Because there's
why
all
would
sorts-
somebody sell it to you?
Why would somebody sell it to me? Well, typically the way a swap is put on is I'll call up the bank and say I need to put on a swap between two clients, or I have a client who needs a swap, and they'll find a counterparty that matches that wants the exact opposite. One wants to pay floating, one wants to receive fixed, and they can put together the two parties. Each party is satisfied because each party is able to address their risk accordingly. And so why would somebody, in the event that interest rates were dropping, sell me a pay floating, receive fixed interest rate swap? Because it meets their risk parameters. That's why. Is that possible in a falling interest rate environment to find that? Yes, just as it's possible to find in a rising interest rate environment a pay fixed, receive floating interest rate swap. If a company has floating rate debt and interest rates are going up, well, then of course you want to get out of that. You'd rather pay fixed and receive a floating rate interest rate swap. If you have floating rate, yep. If you have floating rate debt and interest rates are falling, you don't want to do anything. But if interest rates are rising, you'd rather pay fixed. Just like if you have fixed rate debt and interest rates are falling, you'd rather not do that. You'd rather pay a floating rate, which is going to allow you to pay a lower rate. Why would somebody enter into that swap? Because entering into that swap satisfies whatever their risk objectives are, regardless of what the interest rate environment might be. There's always a counterparty.
If there is any swap fees violation for a company that canceling their swap contract time.
I'm sorry, Sahar, I really didn't hear that. Can you repeat that?
I'm asking if there is any swap violation fees for a company that canceling their swap.
Yes. Well, yes, there is. And so we'll talk about that, I think, on Wednesday, unwinding a swap and the fees associated with unwinding a swap or getting out of a swap by entering into a mirror image of the initial swap. There are ways to unwind a swap using discounted cash flow methodology. We're going to talk about that, I'm pretty sure, on Wednesday. That's a great question. What does a company do, folks, if they want to get out of a swap, if conditions change? Well, there are a variety of strategies that allow companies to do just that. Thanks, Sahar. That was a great question. If we're looking at assets, if you have a fixed rate asset and interest rates are expected to increase, well, you'd rather receive a floating rate return if interest rates are expected to increase. So you'd like to enter into a pay fixed, receive floating interest rate swap. Contrarily, if you expect interest rates to fall, you would do nothing. If you have a floating rate asset and you expect interest rates to rise, you would do nothing because that would be counterproductive for you. Because of course, if you have floating rate assets and interest rates are going up, that's going to increase your return. If interest rates fall while you have a floating rate asset, well, then you want to get out of that, and you'd rather pay floating from your floating rate asset and receive a fixed return on your asset. Okay.
Professor, can you please give me an example of a fixed rate or a floating rate asset?
A fixed rate asset would be a portfolio of treasury securities would be a fixed rate asset. A fixed rate asset would be a property portfolio that generates returns. A fixed rate asset would be, like I said, a portfolio of treasury securities or mixed securities.
Got it. That pay coupon payments, right? That make coupon.
That's exactly right.
Okay, got it.
So let's turn our attention now to commodity swaps. So commodity swaps, again, are the same thing, which is an equivalent to a strip of forward contracts, but instead of interest rates, it's on a commodity. So here, the notional principal, there's no notional principal. Well, there is notional principal, but it's not exchanged. but it's defined in terms of the commodity. So for example, you have barrels of oil or troy ounces of gold, right? It's most often used in the oil markets and in the metal markets. So payments are made comparing the spot strike spread at settlement. What's the difference between the spot price and the strike price at settlement? Terminology that you're all familiar with by now. So as I said earlier, the oil seller or producer is fearing falling prices, wants to lock in her revenue today. The oil producer, he or she fears higher prices. The oil buyer or user, he fears rising costs and wants to lock in his costs today. So he wants to pay a fixed price to the producer, and the producer is going to pay a floating price to the oil user. And that way, both the oil producer has hedged her risk and the oil user has hedged his risk for higher prices. So let's take a look at an example where the oil user wants to fix his costs today for 1 year and decided to enter into a 1-year commodity swap that settles every 3 months. The company is agreeing to pay a fixed price of $65 a barrel in exchange for an average market price based on a notional principal amount of 123,000 barrels of oil. So every time the price goes above the strike price, what's going to happen? Who's going to get paid? The oil user is putting on a hedge to protect against what? Higher prices or lower prices?
Higher prices.
Higher price.
Thank you, higher prices. So therefore, every time the price goes above the strike, the company had better well be rewarded, because that's the very reason to have the swap. Okay, so if the average spot price rose to $68.50 per barrel in the first period, what was the company's cash flow for the period? So look, the price went from 65, which is your strike, to a 68.50, which is the average spot for the period, which means an increase of 350. So the company is going to receive 430,500. That's 350 times the 123,000 barrels gets 430,500. Here we have an example with a South African gold mining company that wanted to fix the price it received for gold over the next 3 years. At the same time, the manufacturer that uses gold in its manufacturing process wants to fix the price it pays for gold over the next 3 years. Here, the notional principal amount was 10,000 troy ounces of gold, and the fixed price was $1,800 an ounce. The settlement was every 6 months and based upon the 6-month average price of gold. So we know that when the spot price is greater than the strike price, it's good for the buyer. Why? Because the buyer is entering into the commodity swap to protect against higher prices. So therefore, the mechanism is that if the price rises above the strike, then the buyer is going to be compensated. The user is going to be compensated, right? When the spot price falls below the strike, that's good for the producer. Why? Because what is the producer entering into commodity swap for? To protect against lower prices. Okay? So if we look here and we plot out the performance of gold over the 3 years, looking at the fixed price we know was 1,800. Here we have the average spot price per period. We show the change in price, and we can calculate through whether the producer has paid or received. Well, we know that every time the price falls below the strike price, then that means what? That the producer is going to receive. So we see that here the strike price, the spot price was above the spot price. That means the producer is going to pay. And we calculated through for each of the successive 4 periods, right? And when again, as the spot price exceeds the strike price or the fixed price, we see that the producer pays. The producer pays, and here the producer receives when the price falls below the strike, and the producer receives. So now we just calculate through what did the producer pay in those 6 periods, and what did the producer receive in those 6 periods. So what was the net cash flow to the producer? In this case, it was $840,000. And both the user and the producer were satisfied because the commodity swap did exactly what they expected it to do, to hedge their risk. Okay?
I have a question. How do you get the average spot price? Is that given the first number?
That's given to you. That would be given to you on an exam, for example.
Oh, okay.
Right? That's given. Of course, that's given.
Okay.
Yeah. Okay. So that covers us tonight for commodity swaps and interest rate swaps. Let's talk about some other hedging. Okay. Here we have an example of a company. Apex Metals has 1 year account receivable of Mexican peso 1 million. Nominal rates in the US and Mexico are 3% and 15%. The peso spot is 5.18 cents. The put option strike price is 5 cents, and the premium of 2.5 cents. The question is using the international Fisher, using the Fisher effect, determine what the expected 1 year peso dollar forward rate is going to be. So what we have to do is set up the equation, which is using the IFE, how many dollars will the firm receive using a forward hedge? Okay, so using the Mexican peso dollar spot that's expected, what is the dollar amount the firm expects to receive if it uses the put option hedge? So we just set up the international Fisher effect equation, which is the interest rate in the foreign domicile over the interest rate at home. We're saying the US is our home market. So we set the equation there. We get the solution, the expectation that the currency should depreciate 10.43% during the period. So that means that the 5.18 cents that the peso is trading at now should depreciate by 10.43%, leading to a price of 4.64 cents or 0.0464. If the firm uses a forward hedge, what will they generate based upon this IFE calculation? Well, it's the million that they're going to get in 1 year, the million Mexican peso times the expected forward rate gives them $46,397. Well, if the company has a put option and the put option strike is 5 cents, as opposed to the expected forward rate of 0.0464, the company is going to use the put option and exercise at 5 cents, less the premium cost of 0.0025, which is going to leave them 4.75 cents times the 1 million gives them 47,500 for a difference of 2.4% going with the put option. Okay. Now we're going to talk about the forward premium or discount, revisit the forward premium or discount with a couple of quick examples. We talk about the forward premium discount as the percentage by which the forward price is less than or greater than the spot rate. And the formula that we use is just the premium or discount equals the forward minus the spot over the spot, the forward over the spot minus 1. It's a very simple calculation. So if the euro spot rate is $1.06 and the 1 year euro is $1.01, then a 4.72% depreciation is expected. All we said was 1.01 over 1.06 minus 1 gets us to 4.72 depreciation. If the pound spot is $1.24 and the 1 year pound expectation is expected to be 1.27, the expected appreciation is 2.42%. What we did again was the 127 over the 124 minus 1 using the forward over the spot minus 1 calculation. So a very common and simple technique for assessing a forward premium or discount using the forward and spot markets. And we talk about indirect and direct exchange rates. So here we have the euro dollar trading at $1.06. The indirect exchange rate is to just flip it over, gets us 1 over 1.06, gets us euro 0.9434. So if the dollar is trading against the Russian ruble at 63.78, we flip it over, we get ruble dollar 0.016. We know that the euro is appreciating against the dollar. That means that the indirect exchange rate has to be depreciating. If the euro is depreciating against the dollar, then that means that the indirect exchange rate has to be appreciating, that the dollar has to be appreciating against the euro. Are there any questions here?
Yes, Professor. On the top that you said 4.72% depreciation expected. Why? I mean, how do we actually know it's depreciated?
Because we know that right now the pound spot, it says that today the pound is buying $1.24. A year from now, the pound is expected to buy $1.27.
Okay.
Okay, that means that the pound is going to strengthen in a year while the dollar weakens, because in a year the pound should buy more dollars. You can find out the exact percentage by using the simple calculation here, forward over spot minus 1. The forward rate is $1.27 over $1.24 minus 1 gets to 242. Do you understand?
Yes, I see now. Thank you.
Fantastic. Sure, Nicole, no problem. Let's take a look at an example where a company is looking to hedge a receivable of Canadian dollars 250,000 by buying put options. The strike price is 79 cents. The premium is 2.25 cents. And the spot price at exercise is 86 cents. My question is, at expiration, how much is the company going to have in dollars if it acts rationally? I want you to take a minute to calculate this. And I'm going to ask somebody for an answer in 25 seconds. So not quite a minute, but half a minute. The first question I have is, will the company exercise its option, its put option?
No.
It shouldn't.
Tell me why no. I have the
spot is higher than the strike.
Because the spot is higher than the strike. That's exactly right. So the first thing is that we're going to exercise at the market price, right? So we're going to exercise at 250 times 0.86 is received. We have paid 250 times the 225. We got to pay the premium. So we're going to net. What's the total we net? Can someone tell us? You can simply say the 0.86 minus the 2.25 cents multiplied with 250 gets us to 209,375. Let's try one more of those. A company is writing 2 pound call options. The lot size, in other words, each call option controls 31,250 units of pounds. The company doesn't own the pounds, but has sold a call option. The company thinks the pound will weaken and that they're going to benefit from the premium payment, and that it will be an out of the money call option at expiration. So they're taking a short position on the pound by writing what we call a naked call option. In other words, they don't own the pounds. So here the strike price is $1.65. Now the question is what is the profit and loss for the seller? So the strike price is $1.65. The premium is 3.5 cents, and at exercise the price is $1.72. So the first question is it an in the money call option or an out of the money call option?
Yeah, money.
Sorry,
In the
is it in
money.
the money or out of the money?
Out of the money.
In the money.
Yeah, the spot price is bigger than the strike.
But
Okay.
it was naked. Naked.
Right, so the spot price is
In the money.
$1.72 and the strike price is $1.65. It means that the call buyer can buy the pounds at $1.65, even though the price went to $1.72, right?
Yeah.
And the problem for the company is what? It doesn't own the pounds. So what does it got to do? It's got to go out into the market and buy the pounds in the spot market. So it's got to buy pounds. It's got to buy pounds at, let's try this again. It's got to
Yes.
buy
They come-
pounds in the spot market at $1.72. So what are they going to receive? They're going to receive the $1.65 plus the 3.5 cents, but they paid $1.72. That means they're losing 3.5 cents on every unit. You've got to multiply that by 2 lots of 62,500 means that the company lost $2,187.50.
And this is because they don't own the stock.
They don't own the pounds. I sold you the right to buy pounds from me at some point in the future at a strike price of $1.65. If the price of pounds is higher than that, you're going to have an in the money call option and you're going to demand that I deliver the pounds. And that's exactly what happens. The price is higher than the strike. And I, the seller who sold you the call option, I don't own the pounds. My bet was wrong. My expectation was wrong. So I have to you're going to pay me the strike plus the premium. But I've got to go out and I've got to buy those pounds and deliver to you. And so therefore it's a loss to me because my bet was wrong. Or my calculation was wrong. My estimation was wrong. My expectation was wrong. Any questions here beyond that?
Yeah, in order to sell a naked.
Pardon me?
I said in order to sell a naked option, a company needs to put a collateral on the side, right?
In order to sell a naked option, the company can enter into a legitimate contract.
Yeah, but
Company
they need to have that collateral cash on the side in order to pay.
Well, yeah, they would need to have. They'd need to be well. Naturally, they need. If you enter into an agreement with, let's say, you enter an agreement with me, and I'm going to write you a call option. You want to make sure that I've got significant assets sufficient enough to satisfy the delivery of the pounds in the event that the call option is in the money. And that's perfectly reasonable. But is that possible? Yes, it's possible. Do companies write naked call options all the time to make money? Of course they do. Yes, not all companies, but certainly companies involved in international trade do, as well as companies that are involved in all sorts of domestic and international businesses as a way to make money on their money. Because in this case, if I had been right, then what would I have received? I would have received, it would have been out of the money call option, and I would have received the 62,500. I would have received the $2,100.
Sir,
Professor,
Yeah, go ahead, sure.
you
just
can go ahead.
thank you. So just to clarify on the first example we did, this is because you projecting that the option is gonna go down, right? That's why you took the spot.
No, we're saying, yes, we're saying that I'm going to receive 250,000 Canadian dollars in a period of time.
Yeah.
Okay, and that I'm concerned that the value is going to go down, and so therefore I bought a put option. The put option allows me to translate or convert my Canadian dollars at a strike price of 79 cents. If it turns out that when I receive the Canadian dollars at some point in the future, the spot price is for Canadian dollars 86 US cents. I'm going to translate at the higher price because I want to generate as much revenue from my accounts receivable as possible. So therefore, I will have allowed the the option will expire worthless. At the same time, though, I will have had to have paid the premium for the put option because that's a sunk cost. That would have been the 250 times the 2.25 cents, but I would have converted in the spot market at 86 cents, leaving me a total of 209,375. Does that make sense? Maria, does that make sense?
The thing that I'm
You
a
have
little
Canadian
bit.
dollars. Listen, you have Canadian dollars coming in 6 months' time. You want to convert each Canadian dollar at the highest possible price in US dollars. So you bought a put option that allows you to convert each one at 79 cents. If at the time you received the Canadian dollars, you can convert it at 86 cents, well then, of course, you're going to use the spot market because the put option is worthless at this point. You understand?
Mhm.
Yes?
Now I see it. Now I see it.
Okay, good. Okay. So therefore, you're going to exercise in the spot market, but you still required for the payment of the premium payment on the Canadian on the put option, which was the 2.25 cents. So that's going to be all in terms of the lesson for tonight. I'm going to get out of this. Hey, everybody. So let's talk about some homework. So in chapter 9, I told you I posted answers to chapter 9 homework that's in there. I want to talk to you about what's to be read in chapter 11. In chapter 11, I'd like you to read pages 357 to 371. Page 371 concludes with the equilibrium exchange ratio. So I'd like you to read from the beginning of chapter 11 through page 371 on the equilibrium exchange ratio, and then on the forward market from 374 to 378, which has 2 case studies on page 378 in the forward market. Beyond that, you don't need to read the other pages in chapter 11. And the
Can
questions
you repeat that again?
Yep. 357 to 371, 374 to 378.
Thank you.
Yep. 371 hinges on the equilibrium exchange ratio, and 374 begins with the forward market, and 378 ends with 2 relevant case studies. On Wednesday, we're going to do more swaps, and I'm going to assign for you hedging homework that I'm working on now, and we'll finish on Wednesday, and we'll post for you after class, and you'll have a good couple of days to go over that. And then next week, we'll do some more hedging, and we'll talk about the final exam, and we'll do a bit of a review on the following Monday, and then we will be good to go on the Wednesday, the 19th, for our final. In the meanwhile, though, we do have a bit of work to do, and I'm going to let you all get to it then. So I want to wish you all a good continuation of your evening, a safe